The next chapter is called Measuring a Nation's Income. In this chapter, we're going to be looking at gross domestic product and how gross domestic product is related to a nation's total income and spending. What are the components of GDP? How is GDP corrected for inflation? Does GDP measure our society's economic well-being? We're now moving from microeconomics, where we studied how households and firms make decisions and interact in markets, to macroeconomics, which is the study of the economy as a whole. So we're going to be looking at inflation, unemployment, and economic growth. Gross domestic product measures the total income of everyone in the economy. It also measures total expenditure on the economy's output of goods and services. Income equals expenditure for the economy as a whole, because every dollar a buyer spends is a dollar of income for the seller. We're going to start out by reviewing a concept that's already familiar to you called the circular flow diagram. So let's look at that diagram. So if you remember, we had households and firms. Households own the factors of production. They sell or rent them to firms for income. And households buy and consume goods and services. We also have firms that buy or hire what we call the factors of production, that use them to produce goods and services. And they also sell goods and services. One part of the market we call the factors of production. So here, the factors of production, wages, rent, and profit are part of GDP, as well as the income that households receive for those factors of production. Spending by households and revenue to firms is also part of GDP. Notice what this diagram omits. It omits the government, collects taxes, buys goods and services. That is not included in the circular flow diagram. The financial system, which matches savers that supply funds with borrowers, so think of banks, is not included. And also the foreign sector, trades goods and services, financial assets, and currencies with the country's residents. That is also not reflected in the circular flow diagram. Pay close attention to how we define gross domestic product. It's the market value of all final goods and services produced within a country in a given period of time. Goods are valued at their market prices. So all goods measured in the same units, we're going to measure them in dollars, that's US dollars, and things that don't have a market value are excluded. So, for example, any chores that you might do around your house are excluded from GDP. Notice that the definition is the market value of all final goods and services produced within the country. GDP includes all items produced in the economy and sold legally in markets. GDP excludes most items produced and sold illicitly. It also excludes most items that are produced and consumed at home. Notice that the market value is defined as all final goods and services. So a final good is intended for the end user. Intermediate goods are used as components or ingredients in the production of the other goods. GDP only includes final goods. They already embody the value of all of the intermediate goods that go into production. So we're not going to include those intermediate goods. Notice also that the definition includes goods and services. GDP includes tangible goods like DVDs, mountain bikes, Gatorade, root beer, and intangible services like dry cleaning, concerts, cell phone service, etc. The definition also states that goods and services are produced within a country in a given period of time. So GDP includes currently produced goods, not goods that have already been produced but have not yet been sold. The definition also states that goods and services are produced within a country in a given period of time. So GDP measures the value of production that occurs within a country's borders, whether it's done by its own citizens or by foreign people located in that country. The definition that states or refers to time means we're talking about a year or a quarter. So a quarter would mean 3 months. So essentially, we're going to be looking at 4 specific components of GDP. We're going to be looking at consumption, which we'll designate as C, investment, meaning business investment, which we'll designate as I, government purchases, designated as G, and then net exports, which we'll designate as N minus X. So we're going to be looking at the difference between imports and exports. Okay, so let's look at the definition of consumption. It's total spending by households on goods and services. But it's important to note these specific things with regard to housing. For renters, C does include rent payments. For homeowners, C includes the imputed rental value of the house, but it does not include the purchase price or mortgage payments. Not included in consumption are the purchases of new housing. Investment, for this definition of GDP or component of GDP, we're going to look at total spending on goods that will be used in the future to produce more goods. So we're going to look at business capital, business structures, equipment, and intellectual property products. We're going to look at residential capital, landlord's apartment building, a homeowner's personal residence, and we're going to look at inventory accumulations, goods produced but not yet sold. Note that investment does not mean the purchase of financial assets like stocks and bonds. Government purchases include all spending on the goods and services produced by the government at all levels, so at the federal, at the state, and the local level. We're going to exclude what we call transfer payments. In transfer payments, examples are things like Social Security or unemployment insurance benefits. These things are not purchases of goods and services, so we exclude them. And finally, we're going to define net exports as exports minus imports. So exports are foreign spending on the economy's goods and services, and imports are the portions of consumption, investment, and government spending that are spent on goods and services that are produced abroad. So adding up all the components, we'll refer to GDP as Y, and GDP then is C plus I plus G plus net exports. So here's US GDP and its components in an example year. In this active learning assignment, look at each of the following cases and determine how much GDP and each of its components is affected, if at all.